Yo guys, welcome to a new weekly stock market update, and it's been an okay week. So our asset value is up at £2,924.04, up 22.22 pounds, which is 0.77%. Like I said in the other video, do I think that this is a dead cat bounce, which is basically where the market has a small recovery before further declining? Yes, I do. Am I fully expecting that? Yes. Why did I put this position in? Basically, I just wanted to make sure that if it wasn't a dead cat bounce, basically, we wouldn't miss out on good prices, basically. So the key change is actually we've added a pie, and this is due to actually one criticism. So in our last video, we actually had two pies, £5 a day. One was just the S&P 500. Obviously, if you guys don't know, the S&P 500 historically has returned about 10% per year. So that's why obviously we're putting £5 in it. It looks a bit turbulent at the moment, a lot of volatility because of Trump, but and I think it will continue to be like that in the next 5 years. But long term, it's had historical strong gains, so I'm confident long term, if not in the short term. And then we've got another pie with the FTSE All World, and basically Reality Income and Berkshire Hathaway. So as I described in my last video, the FTSE All World is for further diversification to the world, and also Berkshire Hathaway is basically because what they do, they invest in income stocks, and then they take the income and they then invest this in well-valued stocks. Now, this is an approach which has really worked well, and that's why we're invested in them. Then we've got Reality Income in this pie, which is a REIT. Basically, this is for if and when rates do get cut, REITs become a more attractive prospect. Reality Income returns about annually 5.5%, which obviously is better than the return you can get just holding cash in a bank account. Although rates are still quite high, which means there's not that much of a difference, which means it's not really worth taking that risk at this moment. But say that differs, rates get cut, and a return on your bank account becomes like 1.52%, obviously REITs would become more attractive and people would invest more in them, meaning that they would get a price increase around about that time. How long you'd have to wait for that to happen is a different story. It's just obviously just trying to build it up while it's at a good price point. And also just reinvesting the income we get from it every month to just drip feed and earn more shares. So one main criticism from that video is obviously in the FTSE All World, people were saying that actually the FTSE All World and the S&P 500 overlap a lot, basically, which is, if I'm honest, a completely fair criticism. In my head at the time, I thought, what happens if this diverges over time? Obviously, the S&P 500 will always have American companies, but what happens if the FTSE All World, they slowly diverge from it, especially if, Trump cycles off America? But it did get me thinking, if I'm honest, because if we look at the region exposure of the All World Fund, North America is 66.4% of that fund. And this is because they've got really strong international trade. So a lot of people argue that American stocks are basically global stocks because they've got such presence around the world. But I did take this on board. And I thought that even if the FTSE All World does diverge, like I think it will, obviously while that's happening, you would miss some of the gains if the income comes into the rest of the world. So I've created this pie, which basically has the iShares China large cap. Now, there are some individual China stocks which I have looked at and have invested into it in the past, like Alibaba, You'll probably see that from my old videos. Now, why didn't I invest in just some individual Chinese stocks? Basically, there's a history of just, Chinese stocks going quite whack quite quickly, and out of nowhere as well. So I'm hoping that just investing in an ETF will, just avoid that. But with the uncertainty in America at the moment, it does seem like the rest of the world has increased because people want to do what I'm doing in this video and just trying to almost hedge themselves away just in case, just in case America does anything else within Trump's tenure. The second we've got is India. Now, this is an interesting one because India has actually been in a bit of a crash. So their stock market has not been performing well recently. It's had a real downturn. Why have I invested in it in such a downturn? Well, in the long term, I think that obviously India has strong population growth. And because of this strong population growth, I think that in the long term, it will be fine. And that this will be actually end up being just a good way to enter the market. Now, we've also gone for MSCI Europe ex UK and the FTSE 100. So these markets tend to be a bit more developed. The ones you see in America, and hence they tend to be less volatile because they've been around longer and they're in more developed industries. Obviously, living in the UK as well and seeing European companies be a part of my everyday life, it's just easier to be a stronger investor in stocks, say, you use on a daily basis because you see how the companies run, you see the products. The final one is FTSE Japan. So I actually just really like the way Japan is being run. Tokyo is an amazing place. I like the direction they're going. Their companies seem to be very good at the moment. The index hasn't obviously beaten the S&P 500, but it has delivered quite strong returns recently. The combination of those 5 ETFs, just £5 a day, will almost hedge us from an already very concentrated American portfolio in the long term. So what am I doing? I'm not doing any more bulk buys. I've just realised it. So what have we got? We've got about 13.5k in our cash ISA. From last time we were investing fully. Obviously, another criticism I got basically was about selling. So I made a whole video saying why did I sell at Christmas, because obviously a general rule in investing is the longer you're investing in the market is better than trying to time the market. And I've always been a big believer of this, right? It doesn't matter whether the market goes down or up. Long term, if you just stick to your plan, investing tends to work out. Now, obviously, I explained in a video a couple videos ago that basically the reason why I actually did sell my stocks is to build cash. Obviously, it makes you a less emotional investor if you've got that cash stockpile on the side, because it means that if your stocks go up or down, you don't care because you've got that cash on the side. The money's not needed in the short term, and it just means that you're less emotional. So what I'm going to do, I've decided I'm going to build the cash next year outside, just try and replenish the cash. And I'm just going to use the cash within the cash ISA that we've got at the moment, and just invest £5 in each of our 3 pies. So that'll be £15 per day. I've calculated, obviously we'll have interest coming in, we'll have dividends quarterly from what we've invested in, but that'll take us to about like 2.5 years. And then I'll slowly in the background be replenishing the cash. As you can see, we've got £210 in the account. That's just literally £15 a day for the rest of this month as well, just to show that we are doing what I planned. But yeah, guys, that's basically an update to the portfolio. It is up at the moment. Can I see further volatility? Absolutely. Like, But, you know, it's gonna happen, I reckon. But peace.